Welcome to Smart Finance Talks, your trusted destination for decoding the complex world of global finance with clarity and precision. In a landscape where gold and the US dollar have long battled for dominance, we dive deep into the historic and economic forces that shape markets, from the collapse of the Bretton Woods system to the modern era of floating currencies. Our channel explores how central banks, geopolitical events, and monetary policy influence not only gold prices, but also the strength of global currencies. We examine why gold acts as a neutral benchmark, how it correlates with currencies like the euro and Australian dollar, and what its relationship to equities and commodities reveals about broader market trends. At Smart Finance Talks, we go beyond headlines to uncover the deeper trends behind inflation, currency devaluation, and global investment flows. Whether you're an investor, trader, or just financially curious, our mission is to equip you with strategic insights grounded in history, backed by data, and relevant to today's markets. Subscribe to Smart Finance Talks, because smart money starts with smart understanding. Gold versus dollar, a historic tug-of-war. The relationship between gold and the US dollar has long reflected a deeper tension between real and financial assets. Gold, a tangible and finite resource, has historically served as a symbol of enduring value and economic security. In contrast, the dollar represents financial assets, reliant on the faith and credit of the US government and shaped by political and monetary policy. This contrast has underpinned a centuries-long tug-of-war in which gold and the dollar have alternated in prominence, reflecting shifts in geopolitical power, economic confidence, and monetary systems. For much of the 20th and 21st centuries, the US dollar has been the world's leading reserve currency, effectively serving as the benchmark against which gold and other currencies are measured. This dominance has given the dollar immense influence over global trade, finance, and monetary policy. However, it hasn't gone unchallenged. The introduction of the euro in 1999 represented a significant moment in monetary history, aiming to offer an alternative to the dollar's hegemony. By 2015, though, the euro had not succeeded in overtaking the dollar's global role, underscoring the deep-rooted trust in the US currency despite financial crises and policy shifts. The historical context of this rivalry goes back to the 19th century, when global economies began moving from silver to gold standards. This transition reflected a growing belief in gold as a more stable and universally accepted store of value. Germany's switch to gold following the Franco-Prussian War in 1871 was a turning point that led many other nations to follow suit, ushering in the classical gold standard era. Yet this system began to unravel in the early 20th century, particularly during World War I, when countries suspended gold convertibility to finance massive military expenditures. The economic turmoil of the interwar period further destabilized the gold standard, with Britain abandoning it in 1931 and the US following in 1933. The Gold Reserve Act of 1934 marked a significant shift in US monetary policy, revaluing gold and banning its private ownership, which consolidated government control over monetary instruments. A new system emerged in 1944 with the Bretton Woods Agreement, which established fixed exchange rates where global currencies were tied to the US dollar, and the dollar was in turn pegged to gold at $35 per ounce. This arrangement worked for a time, largely because the US held the majority of the world's gold reserves. However, as US global spending increased, particularly due to military commitments and foreign aid, dollar supply outpaced gold reserves, undermining the peg's credibility. By 1971, President Richard Nixon formally ended the dollar's convertibility into gold, effectively dissolving the Bretton Woods system and ushering in the modern era of floating exchange rates. This historic interplay between gold and the dollar reflects broader themes of trust, stability, and control in the global financial system. While the dollar continues to dominate, gold retains a unique role as a hedge against uncertainty and a reminder of the real assets that underpin financial confidence. Post-Bretton Woods, dollar decline and gold surge. Following the collapse of the Bretton Woods system in 1971, the global financial landscape shifted dramatically. With the US dollar no longer backed by gold, it became subject to the forces of the open market, where confidence, supply, and demand dictated its value. In the early 1970s, the dollar depreciated sharply against other major currencies, including the Japanese yen, British pound, and West German Deutschmark. This devaluation reflected growing concerns over the US's fiscal position and inflationary pressures, especially as foreign holders of dollars questioned the currency's long-term value in the absence of a gold anchor. As the dollar weakened, investors and nations scrambled for safer stores of value. Commodities, particularly gold and oil, became key refuges during this period of financial instability. Gold, in particular, surged as confidence in fiat currencies waned. Between 1971 and 1980, the dollar lost approximately 30% of its trade-weighted value. This decline underscored a broader global shift in monetary dynamics, where traditional notions of currency stability were upended and hard assets gained renewed appeal. Gold's ascent during this time was not merely speculative, it reflected a broader loss of trust in paper money and central banking policies, as well as a hedge against geopolitical uncertainty. 1970s gold boom and Volcker's policy reversal. The 1970s proved to be a perfect storm for gold. A series of geopolitical shocks, including the 1973 oil embargo, the 1979 Iranian Revolution, and the Soviet invasion of Afghanistan, destabilized global markets. Combined with domestic inflation in the US, which at times exceeded double digits, these events drove investors toward gold as a reliable hedge. From 1971 to 1980, gold prices skyrocketed nearly five-fold, peaking at over $800 per ounce in early 1980. In response to runaway inflation, Federal Reserve Chairman Paul Volcker initiated a bold and painful monetary shift. Rather than relying solely on adjusting interest rates, Volcker implemented a monetarist approach focused on controlling the money supply. Interest rates soared, reaching nearly 20% by 1981. These aggressive policies curbed inflation but also made the dollar significantly more attractive to investors. As confidence returned to the greenback, gold prices stagnated and even declined, ushering in a 20-year period of subdued performance for the precious metal. Uncoordinated central bank gold sales, 1997 to 1999. In the late 1990s, a new chapter in the gold versus dollar narrative unfolded as several European central banks initiated significant gold sales. These actions were driven not by market forces, but by political and fiscal motivations. With the formation of the European Monetary Union underway, member states faced strict budgetary requirements to join the Eurozone, including a mandated deficit ceiling of 3% of GDP. In an effort to strengthen their balance sheets and meet these fiscal targets, many governments turned to gold sales as a quick source of capital gains. Gold, which had long been a non-yielding asset held for monetary stability, was increasingly viewed by some policymakers as an outdated reserve in the age of financial liberalization and fiat currency regimes. The result of these uncoordinated sales was a sharp and destabilizing decline in gold prices. Between 1995 and 1998, gold prices fell by about 25%, undermining investor confidence and further weakening the metal's role as a monetary anchor. During the same period, the US dollar strengthened significantly, benefiting from robust economic growth, rising interest rates, and increasing investor appetite for American financial assets. The shift away from gold and toward the dollar reflected broader trends in global capital flows and an increasing reliance on financial instruments over tangible reserves. Key 1999 sales and market impact. The most dramatic episode in this period occurred in 1999, when two prominent central banks, the United Kingdom and Switzerland, announced major gold sales. In May 1999, the UK Treasury declared its intention to sell 415 tons of gold, a move that shocked markets not just for its scale, but for the manner in which it was announced. The sales were conducted via auctions rather than discrete off-market transactions, amplifying the negative impact on gold prices. Simultaneously, the Swiss National Bank announced it would sell half of its gold reserves, deeming the metal no longer essential to monetary policy. The combined effect of these announcements was swift and severe. Gold plummeted to $252 per ounce, its lowest level in 20 years. These actions, particularly when taken without international coordination, triggered significant volatility in both gold and currency markets. The abrupt decline in gold prices not only hurt investors and gold-producing countries, but also raised concerns about the long-term credibility of central banks in managing monetary stability. The dollar, by contrast, continued to climb, buoyed by a booming U.S. economy and expanding capital markets. Washington Agreement on Gold, 1999. Recognizing the damaging effects of uncoordinated sales and the need to restore stability to the gold market, 15 European central banks signed the Washington Agreement on Gold in September 1999. Under this agreement, the signatories committed to limit gold sales to no more than 400 tons per year over a 5-year period, with total sales capped at 2,000 tons. Switzerland alone accounted for more than half of this total, signaling a gradual and controlled divestment rather than a fire sale. The Washington Agreement was a pivotal moment in gold market history. It calmed investor fears, reduced volatility, and helped stabilize prices. Perhaps most importantly, it reinforced the message that while gold may no longer hold the central role it once did in monetary systems, it still carried significant symbolic and strategic value. The agreement also aimed to support the credibility of the newly introduced euro by preventing further erosion of Europe's gold reserves, helping to bolster confidence in the currency during its formative years. Renewed Central Bank Agreement, 2004 to 2009. Building on the success of the original Washington Agreement on Gold, central banks renewed their commitment to coordinated gold sales in 2004 with a second Central Bank Gold Agreement, CBGA. The new agreement extended the cap on annual gold sales from 400 to 500 tons, providing signatories with more flexibility while maintaining market stability. This adjustment reflected the evolving role of gold in monetary reserves and responded to increasing demand for transparency and predictability in central bank activity. At the time, the gold market was undergoing a resurgence, with prices rising approximately 60% between 1999 and 2004, while the US dollar weakened significantly, losing about 22% of its trade-weighted value over the same period. The updated agreement helped strike a balance between the interests of central banks aiming to rebalance their portfolios and the broader goal of stabilizing gold markets and, indirectly, supporting the US dollar. By 2007, central banks collectively held about 20% of all above-ground gold stocks. On average, gold represented about 10% of individual nations' official reserves. Despite a decline from historic levels, gold remained a key component of sovereign wealth, offering insurance against inflation, currency volatility, and systemic financial risk. General rule: inverse correlation. The enduring dynamic between gold and the US dollar is best summarized by a general rule. The two assets tend to move inversely. Gold often acts as a hedge against inflation and currency depreciation, while the dollar maintains its global value largely through interest rate policy, monetary discipline, and investor confidence. When the dollar weakens due to inflation fears, trade deficits, or loose monetary policy, gold tends to rise as investors seek real, tangible assets to protect their wealth. Conversely, when the dollar strengthens, typically due to higher interest rates or stronger economic performance, gold often declines as yield-seeking capital returns to dollar-denominated assets. This inverse relationship is particularly strong in the case of the US dollar, given its dominant role as the world's primary reserve currency. From 1999 to 2008, the statistical correlation between gold prices and the dollar index stood at -0.84, highlighting how closely their movements were mirrored in opposite directions. This correlation helped inform trading strategies, central bank decisions, and investor sentiment across global markets. Exceptions to the rule, e.g. 2005. However, like all financial relationships, the inverse correlation between gold and the dollar is not absolute. In certain periods, both assets can move upwards simultaneously, as seen between April and December 2005. During this time, gold continued its rally driven by a secular bull market fueled by rising demand in emerging markets, especially China, and the broader commodity supercycle. China's currency revaluation, which allowed the yuan to appreciate modestly against the dollar, also bolstered gold's appeal as an alternative store of value. Meanwhile, the dollar strengthened due to a series of U.S. Federal Reserve interest rate hikes initiated in 2004 and continuing into 2006. The rising rates attracted foreign investment, lifting the dollar's value. Additional support came from the Homeland Investment Act, a temporary tax holiday that encouraged U.S. multinational corporations to repatriate foreign earnings, boosting demand for dollars. Simultaneously, the euro faced political setbacks, particularly after France voted against the proposed EU constitution, adding to the dollar's relative strength. These exceptions underscore the complexity of global markets and remind us that while broad trends are useful, the gold-dollar relationship is also shaped by geopolitical shifts, fiscal policy, and investor psychology. Gold as a neutral benchmark. In a world dominated by floating exchange rates and central bank interventions, gold provides a rare and valuable benchmark of neutrality. Unlike fiat currencies, which can be influenced by interest rate policies, quantitative easing, or fiscal decisions, gold operates outside the scope of central bank control. Its value is largely determined by global supply and demand dynamics, as well as long-term perceptions of value and scarcity. For this reason, comparing currencies to gold rather than to one another offers a more objective assessment of a currency's real strength or weakness. Traditional currency comparisons, such as the widely followed EUR/USD or GBP/JPY exchange rates, are inherently relative. If the euro strengthens against the dollar, for example, it may not necessarily mean the euro is fundamentally strong. It could simply mean the dollar is experiencing weakness. These comparisons can be misleading, particularly during times of synchronized monetary easing or crisis, when many currencies may be declining in real purchasing power, even if their exchange rates remain stable or rise. Gold, by contrast, offers an external point of reference, one that reflects the underlying erosion or preservation of value across all fiat currencies. Identifying strong and weak currencies. By charting gold prices against individual currencies, investors can gain a clearer picture of which currencies are losing value and which are holding their ground. This method effectively strips away the noise of intercurrency fluctuations and focuses on intrinsic strength. For instance, between 2001 and 2008, a period marked by global economic expansion, rising commodity prices, and a secular bull market in gold, gold appreciated at different rates when priced in various currencies. During that time, gold rose the least in terms of the Australian dollar, AUD, indicating that the AUD retained more of its purchasing power relative to gold than most other major currencies. This performance reflected Australia's robust commodity exports and strong economic fundamentals during the period. On the opposite end of the spectrum, gold appreciated the most against the US dollar, USD, revealing the dollar's relative weakness driven by low interest rates, expanding deficits, and inflation concerns. In retrospect, the AUD-USD pair would have been the most profitable foreign exchange trade during that time frame. Investors who went long AUD and short USD would not only have benefited from currency appreciation, but also from the carry trade advantage, as Australian interest rates were significantly higher than those in the US. Broader trends via gold. Beyond individual currency comparisons, gold can be used to analyze broader trends in currency markets. By comparing how gold performs against a basket of currencies over time, traders and analysts can effectively rank currencies by their relative strength or weakness. This ranking provides valuable insights for constructing currency portfolios or identifying the most promising forex trades. Furthermore, using gold as a base currency allows investors to isolate currency performance from temporary distortions caused by central bank actions, economic shocks, or speculative movements. Gold-based comparisons help filter out short-term volatility and focus on long-term structural trends. In doing so, gold serves as a reliable tool for assessing macroeconomic stability, identifying inflationary risks, and guiding investment decisions in the ever-shifting world of global currencies. Gold's aggregate performance. Between 1999 and 2007, gold's annual performance against a basket of 8 major currencies USD, EU, JPY, GBP, AU, CAD, CHF, and NZD offered valuable insight into broader market forces and economic cycles. In the early part of this period, 1999 to 2000, gold's returns were relatively muted. Strong equity markets, driven by the dot-com boom, along with low inflation and high investor confidence in fiat currencies, kept gold prices subdued. Gold was seen as a relic during this time, offering no yield and limited upside compared to booming stock indices. However, the narrative shifted dramatically after 2001. The bursting of the tech bubble, the September 11 terrorist attacks, and growing geopolitical instability triggered renewed interest in gold as a safe haven. Investors sought security in tangible assets amid rising uncertainty and economic instability. Gold prices began to climb, reflecting not only demand for protection, but also the growing recognition of systemic vulnerabilities in global financial systems. The most significant surge came in 2005, when gold prices rose dramatically, up 239% from their 1999 levels. This leap was fueled by concerns over the sustainability of global economic growth, particularly in the face of mounting U.S. debt and a weakening dollar. Simultaneously, the world entered a broader commodity boom, driven by China's industrial expansion and surging demand for raw materials. Gold, as both a monetary metal and a commodity, benefited greatly from this macroeconomic environment. Changing currency rankings over time. Currency strength, when measured against gold, tells a different story than traditional forex comparisons. In 2000, gold outperformed resource-linked currencies like the Australian and New Zealand dollars due to falling commodity prices. At that moment, the US dollar appeared strongest in gold terms. Yet by 2007, the tables had turned. Gold outpaced all major currencies, with the dollar ranking weakest. This shift underscores how rankings against gold can diverge from forex market performance. For example, in 2000, the Swiss franc (CHF) appeared weak versus gold, despite its relative stability in forex markets, highlighting gold's unique value as a benchmark. Inverse correlation between gold and the US dollar. One of the most consistently observed relationships in global financial markets is the inverse correlation between gold and the US dollar. When the dollar strengthens, gold prices typically fall, and when the dollar weakens, gold tends to rise. This relationship stems from gold's role as a non-yielding dollar-denominated asset. As the dollar loses value, it takes more dollars to buy the same amount of gold, thereby pushing up gold prices. Conversely, a stronger dollar increases the opportunity cost of holding gold, which does not yield interest or dividends, reducing its appeal. Currencies that are most negatively correlated with the US dollar often show the strongest positive correlation with gold. For example, between 2002 and 2008, the euro and Australian dollar showed the highest positive correlations with gold prices. Both currencies benefited from favorable macroeconomic conditions, such as rising interest rates in Australia and economic resilience in the Eurozone, that often contrasted with the dollar's relative weakness during that period. Currency-specific gold correlations. The US dollar index, USDX, which measures the dollar against a basket of major currencies, had the strongest negative correlation with gold over this period, at -0.53. This figure quantifies the generally inverse relationship and reinforces gold's sensitivity to dollar movements. On the positive side, both the euro and the Australian dollar exhibited a strong average correlation of 0.53 with gold, indicating that as gold prices rose, these currencies typically appreciated as well. The New Zealand dollar, NZD, presented a unique case. While it experienced a short-term correlation spike with gold of 0.78, driven largely by specific commodity cycles and favorable trade data, its long-term average correlation was only 0.43. This moderate relationship can be attributed to the NZD's high dependence on agricultural exports, which tend to respond to different market drivers than those influencing gold. Supply-side fundamentals of gold's rally. While financial indicators such as inflation, interest rates, and currency values play crucial roles in driving gold prices, supply-side fundamentals have become increasingly important in explaining gold's long-term rally. From the early 2000s, global gold production faced significant constraints that limited new supply and contributed to rising prices. Several factors have constrained gold output. Underinvestment in mining. During the 1990s, low gold prices discouraged exploration and capital investment in new mining projects. This lack of investment created a lag in production capacity when demand began rising in the 2000s. Labor issues. Strikes, wage disputes, and labor shortages, particularly in gold-producing nations like South Africa, led to production disruptions. Power shortages. Chronic energy shortages in countries such as South Africa and China, both significant producers, further hindered mining operations. Environmental regulations. Increasingly strict environmental standards in both developing and developed nations raised operational costs and delayed new projects. These constraints, paired with rising global demand from investors, central banks, and emerging markets, laid the groundwork for gold's sustained upward trend. Gold versus equities, a real asset comparison. Comparing gold with equities in real terms provides a more accurate view of asset performance and purchasing power. From 2002 to 2008, while major stock indices like the S&P 500 and the Dow Jones Industrial Average grew modestly by around 20 to 25%, gold surged by 221%. This stark contrast underscored gold's outperformance during a period marked by economic uncertainty, inflation fears, and global instability. Following the onset of the 2007-2008 financial crisis, the disparity widened. Equities experienced sharp losses of nearly 20%, while gold gained over 50% during the same period. This divergence highlighted gold's role as a protective asset during financial turmoil, outperforming traditional financial instruments when confidence in markets waned. Equity to gold ratios, a historical perspective. The equity-to-gold ratio, which compares the value of stock indices to the price of gold, has proven to be a useful metric for identifying long-term shifts in market leadership. Historically, this ratio peaks roughly every 35 to 40 years, seen in the late 1920s, mid-1960s, and late 1990s, often followed by long periods of underperformance in equities and substantial rallies in gold. Since peaking in 1999, the equity-to-gold ratio has dropped by over 200%, reflecting gold's relative outperformance and equity underperformance. Many analysts suggest that the ratio could decline further, potentially reverting to levels seen in the early 1980s. Such a shift would signal continued strength in real assets over paper assets and reinforce the strategic role of gold in diversified portfolios. Gold versus financial assets. As of 2008, gold represented just 3 to 4% of the total value of global stocks and bonds, a stark contrast to the early 1980s when gold comprised nearly 15% of the world's financial asset base. This decline in gold's share suggests that, despite its recent rise, gold remains relatively undervalued compared to other financial instruments. Given the increasing instability in financial markets, concerns over inflation, and the growing appetite for tangible assets, this low ratio indicates substantial room for growth in gold allocations. If gold were to return to its historical average share of the global financial system, it would imply a considerable further increase in its market value. As such, gold's underrepresentation in the modern financial landscape reinforces its potential as a hedge, a store of value, and a counterbalance to the vulnerabilities inherent in paper-based assets. Speculators influence but do not drive gold prices. While speculators, such as hedge funds and institutional traders, play an active role in the gold futures market, they do not fundamentally drive long-term price trends. Data from the Chicago Mercantile Exchange, CME, shows a generally positive correlation between net long speculative positions and gold prices. As speculative interest increases, gold often rises, suggesting that investor sentiment and capital flows can amplify trends. However, deeper analysis reveals that speculative positions are more reactive than predictive. For instance, between late 2007 and early 2008, net long positions by speculators dropped sharply, while short positions increased, an indication that many were betting on a gold price decline. Yet, during this same period, gold prices continued their upward trajectory, defying the speculative outlook. This divergence illustrates that speculators are not the principal force sustaining gold's rally. Instead, underlying macroeconomic and structural fundamentals such as inflation fears, currency debasement, supply constraints, and safe haven demand are far more influential in driving gold prices over the long term. Gold's rally is part of a broader commodity boom. Gold's price surge in the early 2000s was not an isolated phenomenon, but part of a larger movement in commodity markets. Notably, gold's uptrend began earlier than most other commodities, around late 2001, signaling its role as a leading indicator. This leadership suggests that gold's rise was not merely a reflection of supply-demand dynamics in the broader commodity space, but a deeper signal of systemic concerns, especially surrounding fiat currencies and monetary policy. Subsequent rallies in oil, copper, agricultural goods, and other raw materials followed in gold's footsteps, especially during events like the Iraq War, rising inflation, and persistent weakness in the US dollar. These developments highlight gold's status as a bellwether for global economic sentiment and a reliable early signal of broader commodity supercycles. Gold as an indicator of broader market trends. Gold's performance relative to other commodities can provide insight into the underlying forces at play in the global economy. When gold rises in tandem with a wide range of commodities, it usually signals a weakening US dollar or a broader inflationary environment. This was evident in the mid-2000s when gold, oil, and base metals all surged simultaneously, a reflection of declining confidence in paper currencies and growing demand for real assets. Conversely, if gold rises independently while other commodities remain stagnant or decline, it can indicate unique dynamics influencing gold specifically, such as geopolitical tension, central bank activity, or shifts in investor sentiment. This type of decoupling was occasionally observed during periods of financial instability, when gold's safe haven appeal drew capital inflows even as other commodities suffered from falling industrial demand. Gold as a benchmark for currencies and commodities. Because gold is universally priced and largely independent of national monetary policy, it serves as an effective benchmark for evaluating both currency and commodity performance. Traders and analysts can use gold to rank currencies by observing how much each has appreciated or depreciated against gold over time. For example, if gold rises faster in one currency than another, it suggests the former is weakening relative to the latter. This benchmarking process helps in distinguishing strong from weak currencies, especially when forex movements are clouded by complex monetary policies or regional issues. Similarly, comparing gold's price movement to that of other commodities can reveal whether a commodity's rally is part of a systemic trend or driven by sector-specific fundamentals. By serving as a reference point, gold allows investors to remove some of the noise and distortion present in currency pairs and commodity markets. For instance, gold rising alongside oil might reflect dollar weakness, while gold rising while oil falls could indicate a geopolitical risk premium. This dual function of gold as a currency-neutral asset and a real resource enhances its utility as a macroeconomic diagnostic tool. Global market interconnectedness. In an increasingly interconnected global financial system, the ability to interpret cross-market relationships has become essential for investors and policymakers alike. Gold stands at the nexus of these relationships.